Silver just took a double-digit hit, and I am about to tell you something that is going to sound reckless. I am not worried, and by the time you and I are done here, you are not going to be either. If you own silver right now, I know exactly what you're staring at. A red number, a drop that came fast and came mean, that shaved more than a tenth off your position in a matter of weeks and left your stomach somewhere down around your knees. Maybe you have already had the thought. Maybe your finger is halfway to the sell button as you listen to me. That thought, right there, is the single most expensive thought a retiree can have, and I am going to spend the next few minutes making sure you never act on it out of fear. Here is what you are going to walk away with. By the end of this, you will know how to tell the one kind of drop that actually ends a bull market from the kind that only stings. And I need you to really hear me on this, because right now, on your screen, those two things look absolutely identical. They feel the same. They hurt the same. But only one of them ever means you should sell, and almost nobody will teach you the difference, because fear moves faster than perspective, and it sells a lot more advertising. And there is one test at the center of all of this. One, a single question you can learn to ask that tells a bruise from a wound every single time. I am saving it for the last few minutes, because it is the part that channels flashing red arrows that you will never put on the screen. Stay with me, and it is yours. Because here is the thing that quietly reframes this entire drop. In the whole modern history of gold and silver, there has been exactly one force that ever truly killed a bull market. Not a scary headline, not a hawkish speech, not a bad stretch on the tape. One force, one time, one man. And once you have met him, you will never again mistake a bruise for a wound. So before we touch a single thing about where silver sits today, let me take you back and introduce you to the man who is the answer to the question in the title. Go back with me to the end of the 1970s. Inflation in America is not a worry, it is a way of life. Prices are climbing at double digits. The dollar in a working man's pocket is dissolving while he holds it. Gold, which had been cut loose from the dollar earlier in the decade, has gone on the run of a lifetime, from $35 an ounce up toward $850, and silver has gone vertical right alongside it. And every hard money believer in the country feels vindicated, feels like the smartest person at the dinner table, because everything they warned about is finally coming true. And then a tall, blunt, cigar-smoking man named Paul Volcker takes over the Federal Reserve, and he decides he is going to kill inflation if it kills the economy first. And he does something that had been unthinkable. He drives interest rates up into the high teens, toward 20%. He makes money itself so expensive that the whole country grinds into recession. Unemployment climbs. Farmers drive their tractors to Washington in protest, and he does not blink. He holds. And here is the part one need you to understand, because it is the entire lesson of this video. What Volcker actually did was make a boring old government bond pay you more than inflation was taking away. For the first time in a decade, you could put your money somewhere safe and come out ahead of the rising prices. A real return. A genuine, positive, after-inflation return, sitting right there in a treasury bond. No risk, no drama, no midnight worry. And the moment that happened, gold and silver did not stand a chance. Why would you hold a lump of metal that pays you nothing, that just sits in a drawer, when a risk-free bond is handing you a fat real return on top? You would not. Nobody did. Gold peaked, and then it broke, and it did not just dip. It entered a wilderness that lasted the better part of 2 decades. 20 years. A believer who bought near that top and held on white-knuckled did not get even for a generation. That is what a wound looks like. That is what it actually takes to kill a metals bull. Not a fright, not a flush. A real, sustained, positive return on safe money, held in place by a central bank with the stomach to cause a recession and not flinch. Hold that man, Volcker, in your mind. Hold what it actually took. Because now I am going to bring you back to right now, and we are going to hold today's drop up against that yardstick. And I think the fear is going to start draining out of you the way it drained out of me. Let me name the fear plainly first, because I will not insult you by pretending it is not real. Silver got knocked down hard. It flushed into the mid-50s, a fast, ugly drop, off more than a tenth of its value before it caught itself and clawed a good chunk of it back above 60. And gold, meanwhile, barely flinched through the whole thing and has since pushed back to a multi-week high, which almost makes the silver drop feel worse, like your metal is the weak one. And sitting behind all of it is a Federal Reserve, chaired now by Kevin Warsh, that has turned hawkish. Warsh is talking tough on inflation. There is a rate hike on the table where there used to be a cut. And so the story writes itself, does it not? The story every Red Arrow channel is telling you right now. Let me give you that sell case honestly, because a scared man deserves to hear the strongest version of the thing he is afraid of, not a strawman. The sell case goes like this. Warsh is the new Volcker. Rates are going higher, and they are going to stay higher. Metal pays you nothing. And in a world where a bond pays you something, nothing loses. The bull market that everyone got so excited about was a low-rate party, and the party is over, and the double-digit drop you just watched is not a shakeout. It is the first crack in the dam. Get out now, while you still can, before the two-decade wilderness swallows you whole. That is the case, and I want you to notice something. It is not stupid. It is built on a real mechanism. Metal really does struggle when safe money pays a real return. That part is true. That is exactly why Volcker worked. The people telling you to sell are not lying about the mechanism. They are lying about whether the mechanism is actually present right now. And that is a very different thing. And it is where they are counting on your fear to keep you from looking closely. So let us look closely, you and I, because this is the hinge the whole decision turns on. Is what is happening today the Volcker wound, or is it a bruise wearing the wound's costume? And this is exactly where I need to stop and talk to you directly, because right here, at this fork, is where the choices you make actually decide your retirement. If you are sitting on $100,000 or more in a 401k or an IRA, money you spent a working lifetime building, then a moment like this one, a scary drop and a loud crowd telling you to run, is precisely when the difference between owning something real and owning a paper promise on it becomes the whole ballgame. I put together a free retirement protection guide for this exact situation. It lays out, in plain English, how some retirees are moving a portion of their savings into physical gold and silver without triggering taxes or penalties, held inside the tax-advantaged account they already have, metal they actually own and hold rather than a number that can blink on a screen. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. And if you go through it and you want to talk it over with a human being, there is a free, no-obligation, one-on-one session for folks with $100,000 or more in any retirement account. No pressure, nothing to buy, just answers to your questions. Now let me get right back to the hinge, because this is the part that matters most. Here is the difference between Volcker and Warsh, and it is not a small one. Volcker did not give a hawkish speech. Volcker delivered high teens interest rates, held them there through a brutal recession, and produced a large, sustained, positive real return on safe money for years. A speech is a threat. What Volcker did was a fact you could deposit at a bank. And a threat and a fact are not the same animal, no matter how similar they feel while your position is bleeding red. Today, the Fed is talking hawkish, and talk moves the price around in the short run, absolutely. But talk is not a 20% treasury bond. Talk is not 2 decades of safe money beating inflation. The double-digit drop you just watched was the market flinching at the fear of Volcker. It was not Volcker. It was a bruise, and a bruise, by definition, fades. And now the part the sell case desperately does not want you to think about, because it is the reason a real Volcker is very likely off the table this time. When Volcker did what he did, the national debt was a small fraction of what it is today. He could afford to make money brutally expensive because the government was not drowning in what it already owed. Today, this country is carrying a debt closing in on $40 trillion, and every single point that a Warsh raises rates is a point added to the interest bill on all of it. There is a ceiling now, a hard arithmetic ceiling, on how high and how long anyone can hold rates before the interest on the debt becomes its own catastrophe. Volcker had room to be Volcker. Warsh is standing in a much smaller room. He may want to be Volcker with all his heart, but the debt may force him to be something far softer, no matter what he says into a microphone. The arithmetic is louder than the speech. So sit with what that means for the thing you own. The one force that has ever truly ended a gold and silver bull is a sustained real return on safe money, and the very structure of the modern debt makes that force enormously hard to summon and hold. The wound that killed the last bull is a wound the system can barely afford to inflict on itself. That is not a promise about a price. It is a fact about the setup. And it is why I look at a double-digit drop and a hawkish speech, and I feel something very different from what the red arrows want me to feel. But here is the part that actually changes how you should think about this, and almost nobody gets to it. So let me shift gears and slow down, because it is the difference between understanding this with your head and being able to act on it when the fear is real. It is easy to be calm right now, listening to me talk. It is a completely different thing to be calm at your own kitchen table at 11 at night with the statement in your hand and the number in the reb and your brother-in-law's voice in your head telling you that you got suckered. That is the moment this whole video is really about. So picture the person this is for. A man, an ordinary man who has quietly owned silver for years. not a gambler, not a speculator, a saver who did the reading, who understood the deficit and the debasement and the reasons, and who bought a little at a time and held. And this drop hit him the way it hit you. He is sitting at his kitchen table, statement in his hand, feeling like a fool. The financial channels are telling him it is over. His own gut is telling him to make the pain stop. And every fiber of him wants to press the button, because selling would end the feeling, and ending the feeling is the only thing his frightened animal brain wants. And here is what I would say to that man, and to you, if I were sitting across that table. The feeling you are having is not information. It is just a feeling. The drop did not change one single fundamental fact under this metal. The structural deficit did not heal because the price fell. Silver has run short of demand for 6 straight years now, the world pulling metal out of above-ground vaults to cover the gap, hundreds of millions of ounces drawn down. And a falling paper price did not put 1 ounce of it back. China did not stop pulling record volumes of physical silver because the chart went red. Copper did not uninvent the electrical grid. None of the reasons you bought went anywhere. The only thing that changed was the price. And the price, in the short run, is a mood, not a verdict. The people on the other side of this, the ones counting on you to fold, they are not smarter than you. They are just faster. And they know something about you that you may not know about yourself. They know that a double-digit drop makes even a right man feel like a wrong one. They know that being right and being early feel exactly, identically the same while you are holding through the valley. Volcker's victims and Volcker's survivors felt the same terror. The only thing that separated them was who sold and who did not. Wall Street does not need you to be wrong. It only needs you to be scared. Because a scared holder sells cheap metal to a calm buyer, and that transfer from the people who feel to the people who own is the oldest machine in this market. The shakeout is not an accident that happens to you. For the calm buyer on the other side, the shakeout is the whole point. Now, I am not going to sit here and pretend I know where the price goes, because the honest truth is the most important thing I can give you, and here it is. I cannot promise you a price, and I cannot promise you a date, and neither can anyone else. And the second someone does, you should close their video and never return. Silver is the most violent major metal there is. It overshoots wildly on the way down and just as wildly on the way up. You just watched it flush into the mid-50s and snap back over 60 in the span of days, and it can turn around and do the ugly version again just as fast. It could fall back below where it just bounced from. It could stay cheap for longer than you think you can stand. A few good days off the low are not a confirmation of anything, and neither, for that matter, is a few bad ones. Yes, a growing number of analysts make a serious case for much higher silver, triple digits and beyond, built on that deficit and the stretched ratio between gold and silver. But that is their case, not my promise, and every honest version of it comes stapled to exactly the warning I am giving you now. In the short run, the price answers to the Fed and the dollar and the mood of the paper market, not to the deficit. The shortage is the trend. The Fed is the weather. And the weather can soak you for a long time before the trend ever arrives at your door. This is not investment advice. It is a way of seeing. So here is what to actually do with your own position. And this is not a prescription. It is just how a calm person thinks. First, own the metal, not the promise. The entire difference between the people who survived every one of these shakeouts and the people who got wiped out was whether they owned the real thing or a leveraged paper claim on it that someone else could yank away at the worst possible moment. Second, size it so a drop like the one you just lived through can never force your hand. If a further fall would force you to sell at the bottom to cover a bill, then your position is too big, no matter how right you are, because being forced to sell in the valley is how right people still lose everything. Set it up so a bruise can never become fatal. And third, do not sell into the shakeout. The shakeout is the machine that moves metal from the frightened to the patient. Whatever else you do, do not be the fuel. And here is the honest reason to think this through now, today, while nothing feels urgent. Not fake scarcity. The plain fact that the right time to make a calm decision is exactly when you are calm, which is not the day the price is crashing, and not the day it is going vertical either. It is a quiet, ordinary day, like this one. If you are on your TV, the QR code is on your screen one more time. If you're on your phone or your computer, go to jeffreedguide.com. It costs you nothing to be informed. And for those of you who stayed with me all the way to the end here, there is something set aside just for you. If you have $100,000 or more in any retirement account, and you mention that you watched this full video, you can claim a free one-on-one, no-obligation educational web conference. A real conversation about what you actually own versus what you only think you own. No pressure and nothing to buy. That is for the folks at that level who made it all the way here. And if you are still with me, you are one of them. Now, that one test I promised you at the very top, the single question that tells a bruise from a wound every time. Here it is, and it is beautifully simple once you have met Volker. Do not watch the price. Do not watch the headlines. Do not watch the red arrows. Watch one thing only. Ask yourself, is a safe, boring government bond actually paying me a real positive return after inflation? And can they hold it there? That is the whole test. In 1981, the answer was a screaming yes, and that yes was the wound that broke the bolt for 20 years. Today, the answer is no, not really, not deeply, and not in a way a nation $40 trillion in debt can sustain even if it wanted to. As long as that answer stays no, every drop you see, no matter how vicious, no matter how loud the crowd, is a bruise. It stings and it fades. The day that answer flips to a real and durable yes, that is the day you have my permission to worry. Until then, the fear you are being sold is a costume, and now you can see the zipper up the back. So let me answer the question in the title, plainly, the way I would want it answered for my own father. Silver dropped hard, and I am not worried, and you should not be either, and here is precisely why. Because the only thing that has ever truly killed a bull market in this metal is a sustained real return on safe money, delivered by a central bank with the room and the will to cause a recession and not blink. That is the wound. What we have right now is the fear of that wound, a hawkish speech and a violent flush, laid over a fundamental picture that did not change, and a debt that makes the real cure nearly impossible to administer. That is a bruise, and a man who knows the difference does not sell his metal into a bruise. So think back to that saver at his kitchen table, the one with the statement in his hand who feels like a fool tonight. He is not a fool. He is early, and early and wrong feel exactly the same in the dark, which is the cruelest trick this market plays. The ones who are still standing at the end are never the bravest, and they are never the smartest. They are simply the ones who learn to tell a bruise from a wound, who sized their position so a bruise could never break them, and who refused to hand their metal to a calm buyer on the worst night of the drop. Be that man. Do not just be right. Set your life up so you are still standing to see it pay.